Hi everyone, I'm Roger Montgomery and welcome to this week's Video Insight. Today we're diving into the state of the stock market, booms that build wealth and bubbles that risk it all. Markets are soaring, but there are warning signs, so let's unpack what's driving this rally and decide whether the red flags should be taken seriously. But first, boom versus bubble. What's the difference? A boom is when stock prices climb on the sustaining influence of strong fundamentals, for example, solid earnings or economic growth with deflation. A bubble, though, is when prices soar beyond the fundamentals. Fueled by speculation and irrational exuberance, prices keep going up even if the fundamentals have stopped doing so. The co-founder of GMO and admittedly a perma-bear, Jeremy Grantham, once noted in a Barron's interview, quote, "There are two good standards for a bubble. One is a boring statistic and the other is an exciting behavioural frenzy," end quote. The market PE ratio typically spends 95% of its time within 2 standard deviations of its mean. So we're in an old-fashioned bubble when the market is more than 2 standard deviations beyond that mean. During the internet bubble of 1999, early 2000, the market PE hit 3 standard deviations for the S&P 500, and just before COVID, it hit 2 standard deviations, just as it did right before Trump's April Liberation Day tariff announcement. Today, the S&P 500 is again right on the 2 standard deviation band above its long-run mean. History suggests that extremes rarely end well. Of course, many will say this time is different. When I was at Merrill Lynch in 1999, I can remember US analysts published a massive tome suggesting that the internet stocks of the day were so transformative that, quote, "almost any price can be paid," end quote. Today, analysts will say markets have evolved, margins are higher, companies can generate profits off fewer assets, and they've got less debt, and there's more growth stocks. All of that's true, and eventually that narrative will draw in all the buyers that were ever going to believe it. Next, the rising prices attract those who fear missing out on the rising prices. Eventually, there are no new buyers, and so there's nobody left to sell shares to. And at that point, lower prices are explored by sellers. So even when times are different, prices can become too different. When valuations exceed 2 standard deviations above their historical average, the risk of below average returns rises sharply. The current rally is underpinned by strong corporate earnings, accommodative monetary policy, and a nascent speculative optimism. Earnings margins in Q1 hit 11.84%, well above the historical average of 8.51%, while consensus estimates for single-digit growth this year have kept stock prices buoyant. Additionally, the Federal Reserve's pause in rate hikes has eased liquidity concerns, even as the policy rate remains elevated at 4.5%. But here's some things to consider. Speculation is ramping up, if not already rampant. 33 Russell 3000 stocks have tripled since April, but only 6 of them were profitable last year. I don't think this is the dot-com bubble, when Cisco hit 200 times earnings before crashing. Nvidia's trading at 40 times earnings, and it's generating real profits and double-digit growth. So it's not as extreme, but the, quote, "AI changes everything" hype sounds familiar. Blind confidence can blind us to the risks. So how do you navigate this? First, focus on fundamentals. Stick to quality, companies with strong earnings and reasonable valuations. Trim winners and diversify across sectors and asset classes to avoid over-reliance on any one sector or asset class. And stay connected rather than distracted. Watch central bank liquidity measures and note that earnings season and tariffs could shake things up, especially in the typically volatile August to October window. Well, that's all we've got time for. Join us next week, and in the meantime, continue to follow us on Facebook and X.